Thank you and good evening and welcome to our guests who are in the audience and here on the panel. My name is Pat Marshall. I serve in a variety of capacities here at CCBC and through the Goldman Sachs 10,000 Small Businesses Program. So currently I am working as a facilitator for the Small Business Ownership Program here at CCBC, and I am a lead faculty at the Goldman Sachs 10,000 Small Businesses Program, the Baltimore cohort, and I'm a business advisor for our national Goldman Sachs 10,000 Small Businesses Program as well. And so now that I've introduced myself, I'm going to have my guests to introduce themselves. And we're here today to talk about alternative financing. So remember that alternative financing is different from traditional bank financing. And so our guests are representing various areas of alternative financing. And I'm going to start to my far left, have you to introduce yourself, and then we'll come around.
Good evening. Thanks for having me. My name is Watchen Harris Bruce. I'm the president and CEO of Baltimore Community Lending. We are a mission-based lender and a community development financial institution, CDFI for short. And our organization has been around for 35 years. And we provide alternative and flexible financing for small businesses in the Baltimore region, as well as real estate lending to real estate developers and investors for acquisition, construction, and permanent loans. So this is what BCL is. So for short, Baltimore Community Lending, but I'll refer to us as BCL. We are here to fill the gaps in what the banks cannot do. Thank you.
Hi, my name is Tom Kunkel. I'm an adjunct faculty here at CCBC. I teach the small business courses, as well as also a lead on the small business organization course and program here at CCBC. I also have I'm a lifelong entrepreneur myself. So for any of you out there, I've been in your shoes and done looked into every financing option there is. So I can feel your pain. So hopefully I can, not only from what I teach in my courses, but also what I've lived as a entrepreneur myself, I can hopefully provide that to you. I grew up in a small family business here locally, and then have had and bought and sold a number of businesses, and currently do consulting for several companies in the Mid-Atlantic area.
Awesome. Thank you so much for having me. I like to say good afternoon, good morning, good evening from wherever you are watching around the world, whatever time you are watching this. My name is Lyndsae Peele. I serve as a dualpreneur in the financial services industry. My 9-to-5 is serving as a senior entrepreneurial ecosystem manager for Kiva US. We have a small business loan product up to $15,000, 0% interest, 0 fees, no collateral necessary, no minimum credit score, no minimum time in business, and no minimum revenue in business for entrepreneurs who usually struggle with finding access to traditional capital. My 5 to 9, as I like to say, is serving as the Chief Wealth Officer at Kingdom Vision Consulting. We are a boutique financial consulting practice for minority entrepreneurs. We focus on 5 primary areas known as CLASS in both personal and business finance, credit worthiness, long-term wealth, asset protection, strategic banking relationships, and strategic asset accumulation. It's a pleasure to be here.
Hello. Sorry, I lost my mic. Thank you for your introductions. I'm going to start with Watchen. So with my first question. So why should someone seek non-traditional financing? So financing away from traditional banks.
Well, thanks for asking. The reason someone will seek non-traditional or alternative financing, because that's the only way they may access financing, because they may not be eligible for the banking products for so many reasons. There are a lot of barriers out there. In terms of some of the barriers is the business may be a micro enterprise, very small. Banks do not lend to micro enterprises because so many reasons. They do not have a large balance sheet. Two, they may not have the correct credit score. And also, they may be in the wrong zip code, and that's legitimate, high risk area. And secondly, they may not have the kind of track record that a traditional bank requires. And all of those are okay. So in order to build the track record, build the credit, and start the business to have a proof of concept, they have to seek alternative financing. Just like in medicine, sometimes you have to go to alternative doctors if the traditional doctor cannot help. I'm a reform banker myself, and I love being on this other side because I'm helping a lot of patients who need alternative financing because they cannot get the regular doctors in a financial institution. So for us, we decided to do this as a CDFI. We help people who need financing that they cannot find anywhere else. So our product was designed specifically for underserved communities, meaning people do not have collateral. Everywhere, every lender requires a collateral, even if it's personal loans. Business loans, of course, if you need $5,000 or more, you need some collateral. But collateral does not pay for loans. It's only a guarantee, and you have to liquidate. So we are a cash flow lender, so we look at cash flow. But we work with them. It's not just capital we provide capital plus business development services. And the plus includes everything to help a business with their business plans, the P&L, profit and loss statement, their cash flows. But most importantly, we push them free one-on-one. So our CDFI is more than just a mission-based lender. We create trust, we create relationships, and we work with our clients like they are our family. And we help them, and we do post-technical assistance or post-coaching all through the life of the loan. So it's a lot of hand-holding, but that's the only way businesses can acquire. So because of that, we have a huge demand because there are a lot of people out there who want to start business or expand their businesses, and they need someone to help them through the process. Commercial banks are great, but that's not what they do. So, but we help them create relationships to grow into a traditional bank. That's what we do. So our purpose is to make sure they are eligible to move on to traditional banks. Because we do like the banks. They will help them with growth capital, but we help them to start and build the track record and build their credit to make sure they are performing at least for 2 years, and then we make sure they work with the banks because we are non-deposit taking. We do a loan fund. And so that's why people need us, because they may not have alternative. The alternative is going to a hard money lender or a predatory lender. But we have flexible products from as low as $10,000 all the way to $350. But that's right now our average loan is $90,000. So thank you.
Thank you, Watchen. Tom, why should one look for a traditional lender? A non-traditional.
Non-traditional.
Yes.
First of all, I love the the reform banker comment. That was well, typically, especially both in startup, but also as an existing business. Typically, the biggest struggle that a lot of small businesses have is the ability to grow, to get to that next level. Excuse me, hire that next person, get new inventory, whatever the case may be. Sometimes it's a piece of equipment they might need to grow and expand their business. So with a lot of traditional bank lenders, they are looking for just that collateral and credit score. And without those two, you're really pretty much locked out on a lot of cases. I know in my past, I went to one particular bank and I said I needed a $100,000 line of credit, and they said, okay, why don't you put up $100,000 and we'll give you the line of credit, which kind of didn't make a lot of sense to me, because if I'd had it, I wouldn't need to get the loan. So a lot of businesses can use their existing sales and their existing track record in business to actually get funding. And what I always help students in my class is a lot of people will go, I want to get an SBA. That's kind of the golden ticket for everyone. And the SBA is a great product, but it has a niche. It fits a role. And I think every type of financing fits a different role. It can be anywhere from, and when we talk about financing, it can be anywhere from going to a vendor and saying, hey, I'm willing to give all of my business to you. Can you offer me an extended line of credit? Maybe 30, 60, 90 days, something like that. Maybe it can be going to a lot of your like credit card companies and things like that. A lot of credit card companies and point of sale processors now will actually loan you on future merchant monies coming in. So that allows you, it's essentially you're borrowing on kind of money coming in. But in a lot of cases, when you have funding opportunities, sometimes they come up and you don't have time to spend 3-4 months getting a loan. It might be, I have a new customer. I just got a brand new order. I need to go out and spend $30,000 to buy product in order to turn around a $100,000 order. How do I get that 30,000 to make that 100,000? And a lot of that is using things like factoring and accounts receivable lending, which essentially it's a longer process, but you can actually get set up with a company and be able to factor invoices as they come in. So it allows you to handle much, much larger companies or orders. I know in my business, we tended to be more of a production environment. I owned a marketing business. We did T-shirts, signs, things like that. So I would get somebody who would come to me and say, I've got, like one particular example was about a $30,000 order, but I had to come up with about 10 grand to get the products and materials to make the signs to actually, do the work. And I was able to use accounts receivable financing in order to get that. So especially once you get into business and you have some history, there are a lot of other options that open up versus kind of going to the bank and offering the traditional lending. So I could kind of go on. I do in my classes, as my students will often tell me. But those are the reasons is just to be able to grow your business when you need to.
Yeah, and sometimes people are afraid of traditional banks. And so I always feel like a CDFI or other alternative financing options are less, I wouldn't say less, but maybe present a more friendly face to the process, especially with a very nervous business owner who's looking for financing. And so, Lyndsae, you help people to get prepared for this non-traditional banking world. So tell us a little bit about what you do and add anything to what Watchen or Tom had said this evening about non-traditional financing.
So first, I want to address your statement, right? What you said is absolutely correct. A lot of entrepreneurs are afraid of traditional banking institutions. A lot of it comes from the lack of trust in the system, right? And I don't think that we can ignore history. However, I'm not going to go too deep in that hole, but oftentimes people are intimidated by what they don't understand. And most people don't understand how traditional banking systems work. Most people don't understand how a traditional bank branch works. So when you think about accessing business capital, that's a whole different level of conversation, right? And if they've never been comfortable enough to even really sit and have a conversation about their personal credit and what types of services and products that institution has to support them, then it makes it even harder when they have a business to have those conversations. As a business banker, I spent a lot of time in the community repairing trust, serving as that bridge for a lot of my clients. And honestly, it starts with just coming down to that human level and getting to know them and who they are and their dreams, right? Being able to show that level of interest. So often you have bankers who are salesmen, right? That's a part of their role, is to sell products, so that the institutions can make money. And while it's a business and that has to happen, I think that sometimes bankers miss the mark because they forget that human element, right? So a big part of what I do within my practice is that I get to know my clients. I get to understand who they are, where they came from, starting with understanding their money mindset. Let's talk about your financial habits. Where did they originate? Because a lot of times, some of the things that we see, those habits, when we talk about credit scores, it usually come from things that they did that they either saw and mimicked, or things that they didn't know and they were learning on their own as adults, and they're out here just trying to figure it out. So the first thing is that they have to be able to get to the root of their first money story and understand that dynamic. Did you grow up seeing your parents constantly in debt? Did you grow up seeing eviction notices on the door? Did you grow up and see, failed relationships because of money? And a lot of times, a lot of people have had some form of those experiences that is at the core of how they financially show up. And your average banker, they're not getting to the root of that, right? One, they don't have time to do that most of the time. But also, two, some bankers they're not as relatable to the client. So the client does not build that level of trust to even share that experience with them. And I've been able to do that. And once we actually get to know them and dig through the root of the challenge, because I don't believe in putting Band-Aids on issues, right? Let's get to the root of it so that we can actually fix the problem and not the symptom of the problem. And once we educate them, once we're able to uncover those things and we teach them how to heal from those financial challenges and those generational curses that they are looking to break, then we're actually able to provide that level of financial education to teach them how to maneuver through the system, how to actually access capital, or how to know what type of capital you're ready for, because not everybody is ready for debt capital. So it takes a lot of intentionality behind that work, and I'm very fortunate to be able to do that.
That's awesome, because there is a lot of financial trauma. There's Lyndsae says 100%. There is a lot of financial trauma around lending and the whole process, because financial education isn't necessarily taught in schools. Is now much better, particularly at community colleges are offering more financial education classes. I know we touch on it in our small business ownership class, or we try to help just break down some of the barriers to even just understanding lending in general. So one of the barriers is just understanding some of the terminology. And so I want to go through with all of you and talk about some of the terminology that you think will help some of our business owners. And you work with folks who are seeking capital, and with some of the terminology. And you mentioned Watchen line of credit. So what's the difference between a line of credit and a loan?
Sure. Thank you. Well, that's so much barriers. As Lyndsae was saying, all of these, getting to meet people where they are, creates trust. That's the first thing, because people do not trust lenders because of past history or past experiences. The first thing is, most people go to the bank, but it's retail banking. They know they have to deposit and they have to have a checking or savings account. But a business loan is not. It's on a whole different level. It's not retail. It's not consumer. It's more of a business loan. So going back, you have to understand what type of capital you need, the capital, and why you need it. Because sometimes people don't really even need capital. They just need the financials to tell them what they need to do. So we, as an institution, we have coaches that do needs assessment first. When I was a banker, people came in my office all the time. I need a loan. I said, for what? First, they have not identified what they need the loan for. And I said, how much do you need? Whatever you can give me. That's not the right answer for bankers. Most bankers don't want to hear that. They will say, you are not ready. And they will say next and move on. But we as a CDFI, our approach is to find out deep down why they need the loan, how much do they need, and we help them analyze the needs. But it's not about just the capital. It's really understanding the business life cycle. We try to find out where are they? Are they a startup? Are they at break even? Are they at a sustainability? How do they grow? Are they ready to exit? Because in order to expand, you must be at least be profitable. If they're not profitable and just break even, definitely they can afford a loan. So we analyze the business life cycle from concept all the way to exit. So we identify that. So going back to the question, what's the difference between a loan and a line of credit? A loan is a term loan, meaning we give you a fixed amount for a certain number of years or months. And with fixed interest, or for us, we do fixed, not variable. But in essence, it is a fixed loan. You know how much your payment is monthly. Furthermore, you will be able to budget based on that loan. A line of credit is not a term loan. It is you only pay on what's draw down. It's like a credit card. A line of credit is like a credit card. And usually startups do not get that because you're just starting off, definitely you wouldn't be able to manage a line of credit. It's better to get a term loan and buy whatever. We have people coming to us for inventory or working capital or equipment. But it's a specific need. So if you needed to hire staff or to do marketing, which is part of your working capital, we would just give you the money to purchase that particular product or service. And then you pay in terms, 5 years, 7 years, or whatever term that's determined. And it's a fixed rate. But a line of credit, you are approved based on your ability to manage that credit. And every year we go back and check to see how you are using it. So it's really like a credit card, but it's a larger credit card. So that's a line of credit. And also we educate people on the difference between APR, which is annual percentage rate, and fixed and the regular interest rate. It's different. A lot of the predatory lender would charge people 40, 50% in APR, and people have no clue. But they can never pay off a loan because the APR charges a whole lot because it accrues daily. So teach them not to always ask the right questions. What is my APR? What is my interest rate? So there's a lot of terminology, and that's what we do first before we give people capital. So we have a mantra at BCL called Capital Plus. Yeah. So
I love how you say that you can use a loan to budget, because budgeting is so important in our community as lenders, to have business owners, and even just in your personal life, to understand the practice of budgeting. And so when you talked about having a loan, it allows you to budget. So she's saying that with a loan, you're going to have equal payments over a specific period of time, and you can anticipate what that amount is every month, and you can plan around it. So I like that you explained that. Does someone else want to take on some of the terminology that can really confuse or make someone anxious about lending? Because we have, in the lending industry, have so many names and acronyms and things that are unfamiliar. It's kind of like IT. Your IT friends scare you by talking about things, and you go, wow, if I just understood what you meant, maybe I can understand IT a little bit better. But it's similar in finance and banking. So what else is a hiccup for many small businesses in terms of terminology? And what do you find yourself, Lyndsae, having to explain to business owners?
I think just piggybacking off of Ms. Watchen, thinking about how interest rates are charged, right? So knowing the difference between a fixed rate and a variable rate. So that fixed rate, it's going to be consistent for the life of that credit account for however long you have it open, almost similar to a mortgage. Once you have a mortgage, usually the typical mortgage are usually fixed. Your interest rate is going to stay the same unless you refinance, right? But when it comes to variable interest rates, you think about your revolving lines, like your credit cards, your lines of credit. Those interest rates can change based on what's happening in the federal, right? So the prime interest rate can also trigger changes in that. If you're the financial institution that you're working with, if they want to add some additional interest on top of the change that the prime rate may have altered. So those are important, because if you're not watching those revolving accounts closely, if you're not looking at those statements and you're just carrying balances and just think you're just paying it, if those rates increase, a lot of times it makes it much harder to pay those things off. I even think about credit card rates right now. They're ridiculous, right? A number of folks have credit cards that are 29%. Some lines of credit that are, 17% interest. And a lot of times they didn't start there, right? I can even speak for myself. I have a few cards where the interest rate started at about 13, 14%. But as the economy starts to change, they're in their 20% now. And if folks are carrying balances on these revolving lines, then they can be in trouble, right? Because that interest adds up. And God forbid you're only paying the minimum payment every month, then you're really going to take forever to pay those accounts off. So it's important to know whatever credit product you're applying for, does it come with the fixed rate? Does it come with the variable rate? If it comes with the variable rate, what are the potential changes, or how often could they potentially change, so that you also understand how to measure the nature of how you monitor those accounts?
Yeah, so that's a very good point, because people don't even know what their interest rate is. So one of the big takeaways from what you said is not only understanding the terminology, but know what your interest rate is, because oftentimes I know when I used to be a banker as well, and now as a business advisor, if I'm looking at a loan, I'll say, what's your interest rate on that debt instrument, on that loan? Silence. Right? Silence. Go back and read the small print, find out what your interest rates are. Know the interest rates before you sign the documents, because you're committing yourself to, not just the face value of what you want to borrow, but the interest, the cost of borrowing. And so understand those things, and don't be afraid to ask. You ask that question, your banker's going to be like, what? This is an educated borrower, And so, Tom, what can you think of that is a hiccup for borrowers, for people seeking financing? And in this sense, we're talking about alternative financing, but also these terminologies expand from traditional financing to non-traditional financing. So what is a hiccup do you find for small business?
I find a lot of people, the term cash flow is as a question mark. It's like, what's your cash flow? And people are like, well, I don't understand what that means. And sometimes it's, I see a lot of business owners, they will manage not by their books, but they're managed by their checking account. So they'll look, I need to make a payment today, look at my check register or look online and, okay, I've got plenty of money there, not realizing that they have 3 payments coming out in 2 days. And, really kind of budgeting, some of those monthly payments that you need to budget for. So, certainly using some type of a financial software is critical, and keeping up with the financial software is critical. There's, I don't know if I'll get in trouble for saying one of them in particular, but, there's a lot of them out there that are, that will link to your bank account. They will pull in your transactions on a daily basis, and you can then allocate them so that it helps your accountant, and then you can allocate them so that and you can put in, maybe I have a vendor that I've got to pay net 30, which is another term that some people don't understand. So I have a vendor that I'm paying net 30, so I put that in as a payable, so that I know when I'm coming up to 28 days that I've got that payment coming out in 2 days. Putting any of your fixed payments automatically into the software, so it allows you to really kind of manage by your books, not by what you're balancing your bank account. Because people will, they'll say, oh, well, I've got $5,000 in the account. I can go out and spend, or I just got this big check payment coming in from a customer. I can now go buy something. not realizing that they have other obligations that are budgeted out. So I think that's one area that you need to really manage. And the other area, depending on the type of business you're in, accounts receivable management is also critical. And for people that aren't familiar, accounts receivable is essentially money that you do a job, you invoice a customer, and you send them an invoice. That money now at that point is a debt that's owed to you by a customer. That money, so you're counting on that money to come in 30 days or 15 days, whatever you've set as the terms. I will say from experience that typically a net 30 means you're going to get paid in 45 days. Most people take, I send an invoice, I cut an invoice on the 1st and I mail it, and the customer receives it on the 10th. And that's when they book it as being due on the 10th of the following month, as well as just some people, kind of managing their business cash flow. Because you're also, your customers, if you're, dealing especially in business to business, your customers also are managing their cash flow. So there's also, and the other thing I think in accounts receivable management is that is an asset that you have out there. And I mentioned, accounts receivable factoring previously, where you can actually take that asset and actually use that to borrow against. That essentially becomes your collateral for your business, for being able to go out and either manage your cash flow or potentially borrow against it. Now, those are things obviously you have to. There's a lot of things that go in before you just go out and say, I'm going to borrow. I have $100,000 in receivables, so I'm going to go out and borrow on that. You've got to, go through a process and make sure that makes sense for you. But there are a lot of times that businesses have assets that they don't realize, and I guess accounts receivable certainly being one of the biggest ones.
Here, Mike.
Yes, I just want to share another one, a quick story. We have a lot of existing businesses, not startups, come work with startups and existing businesses. People have been in business probably 10, 15 years, and they don't know the difference between a balance sheet and a P&L. We asked them to give us the financials, and they would just give you receipts. Or some bookkeeper would just put together something and give it to them, but they don't understand what it is. So our education starts there. We help them understand the difference between the balance sheet and what a balance sheet is and what a P&L, which is profit and loss statement. A lot of people know their business. They know if it's a caterer, they know how to cook, they know how to do whatever. But when it comes to presenting their businesses, they have no clue. So we have a lot of people who cannot grow because they do not understand what their business is even doing. They may say they are profitable, and we say, how do you know? Oh, well, my bookkeeper say I'm making money, or I have money in the bank. Yeah. But the money in the bank does not mean you are making a profit. So we help them to understand everything from the beginning in terms of cash flows and P&L, and also what a balance sheet. It will go from the asset, liability, and equity. But we'll go through all that education system, and we'll say, oh, we didn't know. Because nobody has really sat down to teach them. They've been using credit cards to finance their businesses, or just their self-own, they are self-financing. So nobody's really educating them, or they are getting predatory loans. But until you learn those terms and know how it applies to your business, bottom line, you wouldn't be able to grow. So that's an important part of education. So we see technical assistance or coaching is so important than capital. Because in essence, you can give all the capital. If they don't understand what it's for and how they're going to turn it over, they would not, it wouldn't help them grow their businesses. So those are some things people need to learn.
It's really good advice, because what you're saying is that it's okay not to know.
Yeah.
And I think that's the thing about small business owners. You have to give them some assurance that you are really great at what you do. It is not expected that you know how to be a banker.
No.
Right? There's so much that criteria and this nomenclature, all of this, and processes that we go through. And it can really hang up a business owner, and then they shy away from banks. And then there's always that predator.
Yes.
And I want you to talk about what is a predator, and when you talk about predatory lending. Yeah.
Well, a predatory lender is definitely someone who's ripping people off. I mean, let me be blunt. That's what it is. But not all predatory lender really are concerned about your growth. They are concerned about giving you the money with high interest rate and to pay it back in the short term. Predatory lenders are there to make money, period. They are not social mission lenders. They do not care for you or what your business is doing. They just want to get paid back at a high interest rate. So a lot of the predatory lenders take advantage of people who do not know the process or people who are ignorant, but it does not mean they are not good people. I mean, as you said, not people, you don't have to be an expert in financing or marketing or legal, but you need to hire the people who understand it to work with you. Because I know a lot of clients who don't want to hire an accountant or bookkeeper or lawyers to review their documents. Yeah. They would rather go to a predatory lender who will give them a 20% interest rate and pay in 3 months. Because how can you pay back in 3 to 6 months? You haven't even turned over that asset, that you purchased. So in essence, they are not educating you, and that's bad. But also there are some predatory lenders who are fintechs, because everything is online. But not all fintechs are predatory. Some fintechs will take their time to make sure you understand. But most predatory lenders are fintech, meaning they are online. Online, that's financial technology. Fintech is financial technology loan companies. You see all these ads online trying to appeal to people who don't understand finance, but you always should ask someone. And that's why they should come to people like us who understands both sides, because we are all former bankers, but we also experience and understand the difference between a predatory lender and a hard money lender, because we do real estate too. And it's the same thing. Hard money is good for a certain time, but after it's short term and high interest rate. It's quick money, but it will burn you in a minute. So we want people to understand what they are getting in before. So it comes with education. Financial education is very important. It's more important than even the capital. Yeah.
Yeah. Right on. Because education is key. So before someone goes to Watchen for the loan, they may need to take a class, right? So I teach here at the community college, the small business ownership class, and you run through a variety of curriculum, and much of that is on how to, the lending portion of the financial portion of it. So Tom, I should have placed you here because I feel like the schools have really good programs now to help small entrepreneurs get ready for lenders. And then Lyndsae takes that entrepreneur once they had some of the education from us, and you work with them and you get more personal and deeper into their the personality they have or the relationship they have with money. And then they're ready for you. So there's almost a process that all small businesses should go through to really get prepared for the lending process, because the lending process is it's not easy. Even if you're well prepared, it's still a process nobody really wants to go through. You have to ask for money. It's just a very difficult thing. So I want to talk to you, Lyndsae, about your preparation process. Again, you mentioned earlier how you work with distilling the traumas and the myths around dealing with the traumas and then distilling the myths around financials or financing. Can you talk about some of the other tenets of your program? And you're also a reform banker or banker still in still a banker. I think they say once a banker, always a banker. So for all of us who've been in banking, that's what they've told me. Okay, you have not been a banker. Okay. So you're not reformed in that way, but maybe you're a reformed marketer, right? So a reformed entrepreneur. But Lyndsae, I want to give the mic to you to have you expound on some of the things we talked about today, because you see the borrower before they actually enter into that transaction with Watchen.
A big part of the work that we do is we start with dissecting the personal finances first, even before we get into the business numbers. And a big reason why is because most lenders, even your alternative lenders, they're going to pull your credit report. You know, their decisions may not be solely based on the score. However, they're still looking at the tenets of that report, what I like to call your financial resume. So I want to know first, because I don't like surprises. Don't have me send you to a partner and then they pull your credit report and things are not as what we thought it was. So we dig into the personal finances. I want to understand every aspect of your credit, what happened before, even if there were some previous red flags and you've been able to learn and grow beyond that. Let's go ahead and create a letter of explanation in advance so that you already have it in your archives. That's really a letter to explain to those lenders that you're going to potentially be working with what happened during that time, that they're going to see those things on so favorable, whether it was a bankruptcy or whether we had several missed payments, whatever that case may be, especially because with most banking institutions or even alternative lenders, that client really isn't going to meet the underwriter or the voting team that's voting on that application. So you want to make sure that your loan officer has enough information that they can advocate on your behalf and tell a compelling story. So I like to get into the numbers first. I want to understand your overall personal income, because a lot of times, especially for startups, it's complicated to get capital if you just left your job and now you're trying to do this business full time, right? So I love to get people who are still hanging on to their job first, because you can leverage that income from your 9-to-5, or even if you're a 1099 contractor, to be able to support the repayments of that loan. Because the real thing that lenders want to know is, if I give you this, can you pay it back? Whether it's through business cash flow or even if it's your personal check, right? So I dig into those things. I also want to know, do you have collateral? Do you own anything? Because a lot of times lenders want to know if you have collateral, just in case they may need to collateralize that loan. Now, not every single lender needs collateral. However, a lot of them do. So where is the equity? Do you have equity in a vehicle? Do you have equity in your home? Now, the reality is that lenders don't want to take your home. Let's be honest. They don't want to take it, even if they use the equity as collateral. They just want to make sure that they have something, right, to fall back on just in case things go left. So we dig into all those things. I even ask about insurances, because there are certain insurance policies that will produce a cash value. And maybe if you're not ready or in the position to get an approval, can we borrow from that life insurance policy temporarily to get you to a point where we can clean up some things to get you the approvals that you need through your lender? So we dig into all aspects of their personal finances. So I get to know my clients very well. And once we're able to understand all of the dynamics of their personal financials, then we dig into the business. Let's talk about how much revenue the business is producing. Is the business even producing enough to take care of itself? Or are you in the red every month, every year, right? Because if that is the case, then that is a problem. And how do we fix that? Because your lenders don't want to see you in the red on a consistent basis. I know a lot of entrepreneurs, even for some of them who might be making decent money, sometimes their tax returns are not reflecting that, because they're trying to write off an arm and a leg to not pay a lot of money in taxes, in which I understand. However, you're not presenting as a profitable business on paper. So you're not even giving yourself a chance when it comes to a lender. So I want to know, what are you deducting on your tax returns? What is your net number? Not necessarily your gross, but what are you putting on the bottom line that you actually made? Because lenders are going to look at that to really decide how much availability in your cash flow do you have to cover additional debt that's coming. So we dig into all of the personal financials. I want to dig into the business financials to understand before I send a client to one of my partners, because one, that's my reputation on the line, but also two, I want capital to be more helpful than it is harmful. And if people aren't prepared for the capital, if their financials are not putting them in a position where they can get the approvals that they need, then sometimes they're going to be in a bad way once they get that capital. And if you already might have some challenges on your personal credit, which is why you're seeking alternative capital, and then you get in a situation where you fumble that business capital and now you're ruining your business credit and your business's reputation, now it's an even longer recovery period. So I want to make sure that they are ready, that they are prepared and are consistent in whatever it is that they're doing to present themselves in the best light financially.
Great advice. Oftentimes in our industry, we talk about having a bail team, having your banker, an accountant, an insurance person, and an attorney, a lawyer. So that's your bail team. But I think Lyndsae and folks like Lyndsae need to be on that bail team. So maybe we need to call it, I come up with an acronym that includes having a financial coach, because you really do need somebody to help prepare you for that next step. So thank you for that advice. And Tom, you're the entrepreneur's entrepreneur. So as an entrepreneur, how did you prepare for your first loan? If you did need financing, how did you prepare?
First of all, as we all mentioned, personal credit, certainly helps. A lot of the students I have in classes, unfortunately, that is not something that they're very strong in. And that's typically the first question I get is, how do I borrow money when I don't have credit? How do I borrow money if I've got some bad marks? As we mentioned, collateral is key in, banks want to know, as we've mentioned, they want to know if the loan isn't paid, how am I going to get paid back, at least a portion of it. So that's why they need the collateral. And then the credit is really just an indication of your history and your habits and things like that. Now, once you get the business started, a lot of people will ask, well, how do I get business credit? Because business credit is completely different than personal credit. Unfortunately, a lot of times starting out, it's the same. You're signing on personal loans, or you're signing on business loans personally. You're maybe doing a personal guarantee on certain loans and things like that. So it will affect you. Also, a lot of times people will use they'll use credit cards for business purposes, thinking, well, even if I'm paying it back every month, I should be good, right? Well, as the number is typically 30%. If you're over 30% of your total available credit on your credit cards, that's going to start to ding you. And also the credit bureaus pull, depending on the bureau, they will pull at different times of the month. So you may have on the 20th of the month, you may owe $5,000 on your credit card. You may pay it off on the 21st, but if they pulled it on the 17th, you're gonna show a higher balance. So your credit will fluctuate. So we recommend first of all credit monitoring products so that you can see what your credit report is. Constantly check it. Don't wait once a year to check your credit, and things like that. Another thing too is when you kind of get into business, you should always be evaluating loan products. You should always be looking because a lot of times there is a time lag from the time that you all of a sudden, like as I mentioned earlier, you get that big order and then you're like, wow, how am I going to handle this? So a lot of times it is looking at some of those products, being educated, talking to coaches, talking to banks, looking at other products that so you know what's available. And that if something an opportunity does come up, that you have the ability to pretty quickly move into that. Because you will need, a lot of people think, I just need one big loan at the beginning and then I'll be fine. You're going to need money, business credit constantly, whether it's to buy a new piece of equipment, whether it's to, as I said, take on a big order that you didn't, and you have to buy product in advance of that big order. Whether it's to expand and go into a bigger space and you're going to need a bigger, maybe you're going to need some build out money and things like that. Obviously growing inventory, that's something that you also are going to need, money. And those are all good things, the business is growing, which is good, but you also you're going to need typically funding along the way. So constantly being educated. Don't just get a loan and then stop thinking about it, or wait until you get that opportunity to then start looking. So that would be my biggest thing, to tell people.
Yeah. Yes, please chime in on what he said.
What you said was very important, especially when it comes to credit utilization and being able to monitor that, because the golden rule has been 30%, but really lenders would prefer you to be less, right? 10%, 15%. But what people don't understand sometimes is that there's a difference in between your due date and your statement closing date, right? And you have to know the difference. So I'll give a quick example. So let's just say we have a credit card, and just for easy numbers' sake, your balance is $100. Your due date is the 2nd, but your statement closing period date might not be until the 6th. So let's just say on or by the 2nd, you paid $50. So now you have a $50 balance. But let's just say on the 4th, you go out with your friends and now you spent $100. So now technically your balance is $150. If your statement period closes on the 6th, that $150 balance is what's going to actually report on your credit report. And people don't understand that dynamic. And sometimes they feel, oh, I made my payment and now I'm good until the next month. And that's not true. There is usually about a 5 or potentially 6-day window in between that due date and that closing period date. People like me who understand the game and know how to play it, once I make that payment and I pay that card off, I don't touch it until after the closing date. Once it's closed and it's already reported, that's when you can spend up until that next cycle. Yes, still make a payment on or by your due date, but understand that the due date the balance on the due date is not what's actually reflecting on your credit report.
Very good advice. I wish you talking about the game. It is a game. When I was young, I had the game of life. The game of life was a board game. It taught me so much as an 8-year-old to go around. Now you have a job and you have 2 children. Take away $20,000. I mean, it was like the game of Monopoly, but you ended up with a pretty decent future or a dire future. But the game of life is real, right? And that's what you're teaching people to get through that in a lending way. Watchen. How does someone show up to you? So if they're being very prepared, what is that conversation with you?
Well, hello. Yes, hello, it's on. For us, we are a lender. So we definitely underwrite the loans, but our process is such that we have business coaches. We call them technical assistance advisors. They meet with our clients first before they meet the lenders. So we have like 3 coaches that meet all clients at different levels, even graduates from the 10,000 Small Business Program. They come to us.
Yay.
So we meet them where they are in the stage of the business. The coaches will first do needs assessment, evaluation, pull the credit report to find out where they are financially or what stage in the business circle they are. They could be just at a profitability or break even or sustainability, or they need to scale. But how do they know that? So we do the initial assessment first. And it's different for everyone based on where you are. But through that, the coaches request the financials, meaning the business plans, the balance sheet, income statement, and cash flow statements. If they do not have it, we will work with them. The coaches will work with them to create one, or if they have one, we will review and give them advice how to either modify or update. So all of those preliminary, it's the business coaching is something like what Lyndsae does in the beginning. We really do not get into a lot of personal finance, but if we see your credit has a lot of issue with your lower credit score, like something under 600, we will question why your credit score is low. Some is because of medical reasons, other divorces, so many reasons. Others just credit utilization, because business people who are startup use a lot of credit, but they don't realize the credit cards utilization will bring down the score. So with that, we have a partner called Credit Plus. We refer them to our partner to help them build their credit up. We will still work with them to get the loan, but it's usually a condition to work to improve their credit. Those are part of our conditions in the loan. And then once the package is ready, our coaches will turn it over to the underwriter, which is our loan officers, who will underwrite, do the credit memo, and get it ready for loan committee. I'm on the loan committee, but we have like 6 of us on the loan committee that reviews the loan. But that will not go to loan committee until the package is ready. It could be 2 weeks, 4 weeks, or even it depends on if their readiness to move forward. So that's when we approve. So every 30 days, we approve loans. So it's moving. So if you want your loans approved for a certain month, you have to submit the documentation to our coaches for the underwriters to take it to the next level. So once that's done, then it comes to the loan committee. And every Thursday, Friday, like tomorrow, we have loan committee. We have like 10 or 15 loans we review and approve it. And sometimes it goes back. If the loan committee, we think it's not ready based on the credit memo, we look at cash flows, we look at everything from the history. But the loan officer write up everything and send all of the credit reports and all. So based on that, we will approve the loan. But sometimes it's with condition. And we always ask your primary source of repayment is the business, but we look for secondary source. The secondary source could be your current job or your spouse, if they're jointly apply, somebody, and sometimes they have contracts. We do contract financing. So we'll see where the contract, and that contract will be assigned to us as the guarantor. But they also have to personally guarantee the loan if they are not using collateral. A lot of our borrowers do not need collateral, but if they are on the borderline, will require collateral if they have it. Yeah, so.
That's a wonderful caption to this entire Think and Grow series, is how to approach a lender and not to be afraid of investigating your resources in the alternative financing world, and to have a CDFI, Community Development Financial Institution, which you can go to CDFIs in the state of Maryland or whatever state you happen to be in. It'll give you a list of all the CDFIs and all the criteria around where they lend with the zip codes and so forth. But this is a great resource for small businesses, for startups, and for mature businesses to seek alternative financing. So as we close, I do have a rapid fire round for you. So just very quick answers. I'll start with Tom. If you had $10,000 to invest in a startup today, what would you look for first?
You're supposed to prep us for these questions.
Oh no,
Yes.
was I? It's rapid fire. First thing that comes to your mind.
First of all, okay, so if I had $10,000, what would I invest in? Probably education, to be honest. I would. I think that financial education and technology. The other, I could also be technology. I think we don't. There's a lot of technology out there, and I know a lot of people are scared of technology. But obviously, younger people probably not as much. But point of sale systems, software, like I mentioned earlier, whether it's QuickBooks or other products, those. If you have them linked, to your bank account, linked to all your credit cards, all your everything's flowing together, it allows you pretty quickly to give yourself a snapshot. You should be able to literally sit at the end of the day and be able to pull a report and see where you are at that point in the month. Are you going to make your payroll? Especially once you start to get people on payroll, that becomes a big challenge. I always say we always live paycheck to paycheck as a person. Businesses live payroll to payroll. So I would say technology and education would be the two biggest things to invest in.
Awesome. Lyndsae. What's one funding myth you want to bust right now?
That the internet gurus are telling people a lot of things, that you go and establish an LLC and you're going to go and get $250,000 in credit. And that is not true. It is a process to credit, especially if your personal credit is not at the score in the position that lenders want to lend. So take your time. It is not a race. It is a marathon. You want to be intentional because your reputation relies on that.
Yes, lots of TikTok advice. Watchen, you're our final question answer for today. What's the biggest mistake business owners make when seeking funding?
Well, I think one of the biggest mistake people make, they assume that all lenders are the same.
Yes.
All lenders are not the same. That's why we are alternative lenders. We are creative, we are innovative, and we structure the deal to meet our criteria. Even if our criteria, you do not meet it, we can mitigate the risk, and we can deviate from our criteria by finding some way to mitigate and have a mitigant. What that means is we find another way to make it happen. And part of our mitigant is to do comprehensive technical assistance. That is a credit mitigant, but it's an enhancement of the credit. So not because we are lenders, that means we are a bank. We are not a bank. We are not a deposit taking, but we are a mission-based lender. So seek out a CDFI or alternative lender if you are just starting or if you're a small business needed to grow. Secondly, the enough myth, SBA is not a lender. They guarantee loans. We are an SBA lender. We are micro lender and SBA community advantage lender. We can lend up to $500,000 as an SBA lender, but you still have to go through our underwriting criteria because SBA does not give you loan. They only guarantee your loan.
Thank you very much. Those were very good last phrases of advice. And I want to thank our guests, Watchen and Tom and Lyndsae. And I'm Pat Marshall. Thank you for coming to our Think and Grow series.